once you start seeing the weakening of the labor market, it means it's going to continue happening for a while. Because once it shows up, it means you're seeing the tip of the iceberg of this process that's happening underneath. There's a bunch of people who will be laid off, a bunch of people who are currently laid off, or in the the last 2 weeks, the last 3 months, people who are in their severance period. All these things happen before you get to the unemployment rate going up, and so that's concerning.
Does AI factor into this at all?
Yeah, so you get people getting laid off in the tech sector, so those white-collar jobs that are also being lost without any real expectation that they're going to come back. And so you're expecting, recession then. Have you heard about the jobs numbers and what it's pretending for the future? Do you feel the danger, the precipice that we're on for what can happen for the unemployment rate?
I didn't realize we're on a precipice. Last I heard, 250,000 jobs downward revision. BLS admin fired, which are you not allowed to fire government officials? Like I don't understand the drama there. They got the numbers wrong. They always get the numbers wrong. Then they should have always been fired. But I didn't realize that it put us on a precipice.
Well, the unemployment rate has been low for quite a while now, right? I think it's been hovering like a 4.1. It just ticked up to 4.2. But do you know what always precedes the unemployment rate going up?
Rate cuts.
It going down.
Oh,
it going down. So the unemployment rate has been down and has not fallen. It's been stable, and now it ticked up. So now we're looking for unemployment rate issues here. Now, what we've been seeing is stuff like the ISM, which has been troubling me. The ISM came in, 46.2, 46.4. It's a diffusion index. It's a diffusion index that tracks the non-manufacturer sentiment. It's a sentiment survey for different market participants within the supply chain.
I'm sorry.
When most people who, not like you, people who make real decisions for manufacturing and wholesalers and mining and production, more than 50% of them think that things are going to be better in the future, that number goes up. When they think it's going to go bad in the future, that number goes down.
Why didn't you just say that?
And if that number stays below 50 for a while, that's like not usually a good thing. In fact, it usually ebbs and flows and ebbs and flows. We've shown it on the stream before. Let me just go ahead and show that to you right now to remind you. But essentially, we're at 46.4, which is all right. So we're at 48 here, and so we have not been rising. Right, so we are expecting growth, or at least this is a diffusion index, and it's a survey, so it's expectation of growth. And what we're seeing is that people are not seeing that. And in fact, I haven't seen this level of sideways action in a while. I mean, I say but we haven't seen this. It's usually been up, down, up, down, up, down, up, down, and we're not getting that. And so this is a period of like stagflation that's happening right now. But then you add to that stuff like for the jobs numbers, you have the 10-year note, the 10-year U.S. Treasury was down to 4.255%. It was at 4.3 before. And the 30-year came down. All these bonds, their interest rates are coming lower. If you take a look here at the bond rates, you can see here that they've actually been falling. So this is indicating disinflation or maybe even deflation, which we talked about last Friday. But the initial jobs numbers, that came in higher than expected at 226,000 versus 221 expected, up from 219. We have continuing jobless claims that's up at 1.974 million, up from what it was before. So we have a weakening of the labor market. And once you start seeing the weakening of the labor market, it means it's going to continue happening for a while. Because once it shows up, it means you're seeing the tip of the iceberg of this process that's happening underneath. There's a bunch of people who will be laid off, a bunch of people who are currently laid off, or in the the last 2 weeks, the last 3 months, people who are in their severance period. All these things happen before you get to the unemployment rate going up, and so that's concerning.
Does AI factor into this at all?
Yeah, so you get people getting laid off in the tech sector, so those white-collar jobs that are also being lost without any real expectation that they're going to come back. And so you're expecting, recession then, right? At the same time, what you're seeing is, all-time highs for major assets and indices. So you normally see that at the top of the bubble. You normally see that at the top of the global financial crisis, at the top of the dot-com bubble. It's sort of like, look out below, we might be on a cliff, because the momentum of asset prices going up and things going bad for the economy. Well, there's a mean reversion that happens there, and then you can have a big drop. So it's nerve-wracking. Now, I want to actually pull up the reason I care about that is so that we could trade off of it. Right, so there's all kinds of trades there that are great for that. You could be shorting bonds, not financial advice. Do your own research. You could be shorting bonds if you think inflation is good. It's deflation right now, and that rates will head lower. Heck, they might even go down to zero. So you want to be shorting bonds. You probably want to be long gold, because when there is issues with the global financial system, gold is the safe haven assets of central banks, and so you can be a little barnacle on that tortoise and just ride that wave up with gold. So there's different types of trades you can take. But here, as you know, I've been a big advocate of the poly market trade. Events-based trade.
Okay, we went a full 8 minutes without you mentioning poly market. That's a wrap.
Well, before we get there, all right, well, let me just give a little teaser here of what that bet can be. So if we take a look at Polymarket right now, and you can have equal types of bets on Kalshi for the U.S. people. Right now, the betting market is pricing in a 76% probability that the Fed cuts by 25 basis points in September, on September 17th. 76%, right? If you believe that's true, you can go ahead and buy that. $100 gets you an extra 30. Make it $30 on that. All right? But what if they cut by 50 basis points? Well, then you get yourself a cool $1,500 on a $100 bet, which is pretty good. That's pretty good. 150 to 1 here. I'll take that bet. And so the question here is, what is the likelihood that this can happen? Well, two things we know. The Fed likes to keep things like consistent. They don't like to change things up all the time. So we did 50 basis points cuts in for COVID and lockdowns, and we did the 50 basis points rise from when they were hiking interest rates. So chances are they're going to stay at 50 basis points. I'm surprised more people aren't saying this. They're generally going to stay at 50 basis points. That's my assumption. They don't like changing things up. All of a sudden now we're going to cut by 25 basis points. Maybe not.